Please welcome John. Thanks.
Thank you. So I want to talk about innovation from the perspective of capital financing. And I want to talk a little bit about the role that private financing may be able to play in funding innovation and innovative projects. And I think there's a lot of talk in the industry today about public-private partnerships. I want to first define that for you. And some may think that any relationship with between the public sector and the private sector is a public-private partnership, and to some extent that is correct. But I'm going to narrow that definition a little bit for this presentation anyway, and I'm going to use what's more commonly known in the international community as a P3 and what that is, and then I'll talk a little bit about some of the benefits and then limitations of P3s in the United States for funding innovative projects. So the international definition of a public-private partnership is shown here. So it's a long-term contract between a public entity and a private entity, which can last 30 years, 40 years, really long-term. There's a sharing of risk and responsibility, and there's a sharing of control over the asset or the project. I think to some extent there's at least maybe at the federal level, there's some misunderstanding that private infrastructure or private entities can come in and solve the infrastructure gap. And when you look at a P3, there's got to be a revenue source that supports it. If there's no revenue source, there's no P3. And so that gets back to user charges, and customers need to essentially pay for the project, whether it's publicly funded or whether it's you have a private partner. And then finally, I think one of the key distinguishing features of a P3 is that it does involve that private financing element. And so that introduces some challenges in the United States given our current tax laws. And there's been some efforts to try to change those I'll talk a little bit about that in just a few minutes. A P3 is nothing more than an alternative project delivery approach that bundles 5 services into one contract: design, construction, finance, operation, and maintenance. So in the spectrum of level of risk transfer, which is on the bottom axis here, and the level of control transfer, it falls in between what's typically referred to as a turnkey project delivery approach, so design build, operate, but it falls short of private ownership of the asset. So it's in that range is where P3 and at least the international definition of a P3 falls. So one of the biggest benefits of a P3 and is risk transfer. And when you talk about innovative projects from the capital side of things, transferring or balancing risk or de-risking a unproven approach or an approach that is just scaled and it's the first one or there's some innovative aspect to it. Being able to transfer that risk or share that risk with the private sector is one of the biggest benefits. So these are just some of the typical risks that get transferred in a P3 arrangement. So design, construction, cost, and schedule risk gets transferred, as well as you lock in financing, which is a risk that the private sector would take on. Cost related to long-term operation and maintenance associated with a capital project. And then demand and availability risk, which is really the ability to deliver the project, either to achieve the outcome that's being desired. So there's some guarantee that's provided under a P3 to establish that, or maybe it's just the assurance that you're going to get the quality and the quantity of the service under this arrangement. And then finally, a revenue transfer risk, which means that you can lock in the long-term cost of the project and the revenues to support it. There's some certainty in terms of what that's going to be over a long period of time. So those are the typical types of risks that can be addressed in this type of an arrangement. So begs the question of when does it make sense for utilities to consider a public-private partnership over just a conventional approach for project delivery or a conventional financing approach. And here in the United States, we have a really robust municipal financing market. So the bond market's the most robust in the world. We have a great state revolving loan fund program. So why do we need the private sector to come in and solve that infrastructure gap? I think the answer to that question and when a P3 might make the most sense is when you can't get the benefits you're looking for from a conventional approach. That's where a P3 may fit in. And so level of certainty is one example. So if you really desire to have certainty regarding how much is this project going to cost over the life cycle, you can lock that in with a P3. Capacity, if you don't have the knowledge or the capacity to implement the project over a very short period of time, so maybe this is regulatory driven and that regulatory schedule is just so tight that it's going to be very difficult within the current organization to accommodate that. That's another area where a P3 could help. I talked about risk transfer, access to capital. So a P3 approach can preserve debt capacity. So it allows it's essentially the private sector is taking on the financing so that the public sector can preserve that debt capacity. And then some projects, I think, are ripe for letting those competitive factors come into play and lower the total life cycle cost of the project from planning and design all the way through to operations. And those are the projects that I think are more ripe for a public-private partnership. So I want to talk about just a couple of real quick examples. And there haven't been, according to the definition I just talked about, there haven't been a tremendous amount of P3 projects in the water sector. And there's a couple of reasons for that, but let me just talk through some of the more notorious ones. One is in 2012 in Carlsbad, California, the desalination facility. That was a large project. It's one of the largest is the largest in the Western Hemisphere. A lot of technology risk associated with that project. So this was a partnership between the San Diego County Water Authority and a private partner, Poseidon. Big, large-scale project, $1 billion in cost, and it was implemented under a P3 approach beginning in 2012 because of that technology risk and the desire to transfer some of that risk to the private sector, as well as lock in the cost and the schedule associated with implementation. So all the construction risk, the delivery risk, ensuring and providing guarantees that you'll have a certain quantity of water and quality of water coming out of the facility. All of those things all those aspects were transferred over to the private sector. So it gives you just an example of how a technology project that involves some relatively innovative technology back in 2012 was used, how a P3 was used to address that. Another quick example, in 2016, this is a pipeline project. It's a water supply project in San Antonio. And the San Antonio Water System, or SAWS, entered into a P3 with a private partner to develop this water project. And it consisted of building or developing a well field, building a 140 some odd mile pipeline, and then making an interconnection with the SAWS system. And this is a great example of how much risk can be transferred to the private sector. So the development of the project and the risk associated with securing 3,400 leases for the well field, securing all of the rights of way and easements along that 142-mile pipeline, the cost associated with the project from design through construction through operations was locked in. In addition, the contract had set up that any unknown circumstance, any uncontrollable circumstance was not the owner's responsibility, it was the private partner's responsibility. So a lot of risk was transferred through this process. And it's important to note that this example and the one prior, big projects, so large size capital projects, and over, the contract was over a long project period. And those are two aspects that I think make a P3 alternative right. And so that you have to have scale, you have to have a long-term contract to spread those costs and those savings over that period of time. My last example is not a P3, but it's pretty darn close to a P3. It's not a alternative project delivery approach that provides the risk transfer. It's the financing mechanism. And there was an article in the journal, AWWA journal, I think just last month, on this pay-for-success type contract. This is an example, it's really a demonstration project where DC Water had developed a contract with an investor group, Goldman Sachs, and a foundation, the Calvert Foundation, to implement some green infrastructure. And the project essentially consisted of taking some impervious area within the DC Water's stormwater service area and converting that into bioretention facilities and permeable pavement, and to help satisfy the regulatory requirement. And so they entered into a contract with this investment group, and the financing terms are going to be determined based on the success of the project in terms of how well the green infrastructure will reduce stormwater runoff. So they set up performance requirements, and so if the stormwater runoff reduction is what is anticipated, DC Water is going to pay the investor group about 3.4% per annum interest rate on the borrowing. However, if the project is not successful and DC Water needs to then implement more gray infrastructure, there's a clawback there where the investors need to return about $3.3 million back to DC Water because the project isn't successful. And then, however, if the project is more successful than the criteria, then DC Water needs to pay the investors more. So that's why this is a pay-for-success contract. It is dependent upon the performance and the outcomes of the project. This idea came from other sectors. This type of approach is being used in the healthcare industry, in the criminal justice area. It's really new in the United States. Only been around for 4 or 5 years. It's just an example of how you can transfer some of that innovation risk to the private sector and achieve some of the outcomes that you're looking for. Okay, so there's that all sounds great, but there's a lot of challenges, I think, still in the industry in terms of using these types of approaches. And one of the challenges, which is unique to the United States, is the cost of money difference between the public sector and the private sector because of our tax laws. And just last week, the House had implemented some bills that would add to the challenges, unfortunately. So the private cost of money is certainly higher than the public cost of money, and that's one of the hurdles that needs to be overcome. There's something called private activity bonds, where it allows a private partner to finance projects at tax-exempt, with tax-exempt debt, and that's the piece that currently the House is trying to eliminate in their tax proposal. So that's a challenge. It's an opportunity if the federal government could add tax incentives to encourage leveling that playing field between the public cost of money and the private cost of money. Secondly is project size and scale, and I alluded to that previously. The projects that I had mentioned, most of them are big, large-scale projects, $100 million or $500 million or more in size, and that size is needed currently to attract private partners. There's a lot of upfront transactional cost, due diligence that needs to be done both on the public sector side and the private sector side, and so you need to have the scale in order to attract investors and to absorb that upfront cost over the life cycle of the project. Third, I think there's still a fair amount of discomfort in terms of transferring of control from the public sector to the private sector, and I think there's an opportunity there in terms of more documented successes and how that partnership could work, more balancing of that level of control between the public sector and the private sector. So there's some education. I think there's some more to be done to demonstrate that can work in the public sector. And then finally, enabling legislation. There's only 37 or 39 states in the US that allow for these alternative project delivery approaches to be used. And so there would be more opportunities if there's more enabling legislation enacted. I want to just, for my last comment, I wanted to just point your attention to the project size and scale issue and the opportunity of aggregation. And because we're so decentralized in the United States, that's a real challenge in the water industry, and it's a challenge in other asset sectors as well. I'm going to show you just one last example from the transportation side, and this is a project, a P3 project that bundled over 500 bridge replacements in Pennsylvania and bundled that into one contract to try to develop or generate that scale needed to make this viable for a P3 type arrangement. So these bridge replacements cost about $2 million, $3 million a pop to do, and there were estimates in the public sector that if this was going to be done under a conventional approach, it would take 20 years to replace these 500-600 bridges across Pennsylvania. So the Pennsylvania Department of Transportation bundled these projects into one program and then contracted the design, the construction, and long-term maintenance under a P3 arrangement. And the results of that I think were pretty eye-opening in terms of being able to accomplish the replacements of these bridges in 4 to 5 year period instead of 20, and also there was documented savings of about $180 million over the more traditional approach, or a 20% saving. So it just gives you an example of how that. I know that the transportation sector is different because you have this overall arching organization, PennDOT, that can do that aggregation for you. But if we can find a way in the water sector to partner with each other and create scale, P3s may be more viable. And so that was my point in terms of giving you this example. And lastly, I was part of another Research Foundation project talking about new capital providers for infrastructure funding, and there's more information that you can gather on that research report at that location there. So with that, I'd love to take any questions.